Welcome. We are following this book. Today's lectures on prepare closing entries and a post-closing trial balance. This is the chapter 4, completing the accounting cycle. Learning objectives 2, prepare closing entries and a post-closing trial balance. Preparing closing entries, posting closing entries, or preparing a post-closing trial balance. Just today we discuss on this three subtopic. Prepare closing entries and post-closing trial balance. This is the learning objective 2, and on these topics we will proceed our lecture. At the end of the accounting period, the company makes the accounts ready for the next period. That means, just according to this point, we could say at the end of the accounting period. That means, suppose this is the accounting period 2020, and the accounting period here, this is December 31st, suppose December 31st, and then 2021. Okay, so here this is the end of the accounting period. That means this is the accounting period end. The company makes the accounting ready for the next period. That means here the company makes the accounting ready for next period. And how could they make the account ready for the next period? Just here we have two types of accounts in our trial balance. Some are temporary accounts and some accounts are permanent accounts. So temporary accounts, these accounts are closed. That means this is temporary accounts. Which place we closed, which point we closed, this is the point. And this point, December 31st, 2020, here we close the account. Three types of accounts we closed. All revenues accounts, all expense accounts, and owner's drawing accounts. And this is the permanent accounts. These accounts are not closed. This is all asset accounts, all liabilities accounts, and owner's capital account. This is the permanent accounts. We should not close these accounts, but we must close this account. That means these three types of accounts. Okay, then we can ready for next period. Now, preparing closing entries. Closing entries formally recognized in the ledger the transfer of net income or net loss and owner's drawings to owner's capital. That means, when we prepare our owner's capital account, the owner's capital account just addition net income and subtraction. This is subtraction owner's drawing. Okay, suppose here owner's capital 10,000 and net income according to this question 2,860. 2,860 means 2,860, and this is the drawing 500. So after calculation we get 12,860 minus 500, then 12,360. 12,360. This is the owner's capital, the present owner's capital. That means at the end of the period, the owner's capital. That means at the closing date accounts. This is the here the owner's capital will be 12,360. Okay. The company generally journalize and post closing entries only at the end of the annual accounting period. That means this is the annual accounting period. Suppose this is the 2020 and this is the last date. That means December 31st. December 31st, this is the last date. Okay, here we call this is post closing entries at the end of the annual accounting period. This period is December 31st. The closing entries produce zero balance in each temporary accounts. Earlier slide, we have seen that all revenues accounts, this is the temporary accounts. These accounts are closed. That means temporary accounts three types. All revenue, the balance will be zero. All expense account balance will be zero. The drawings account balance will be zero. So here we call these three types of accounts. That means closing entries produces a zero balance in each temporary accounts. That means revenue accounts, expense accounts, and drawing accounts. I think everybody is clear now. I will make clear the preparing closing entries process. So here the individual expenses, the all expenses we write down here, and all revenues we write down here, and here that means income summary. Income summary, just suppose our total expenses according to this question, total expenses 7740. That means here we will write down 7740. This is our all expenses, and here all revenues according to this question 10,600. Okay, that means this is the 10,600. This is the revenue, total revenue. So in our income summary, just we will show this is the revenue and this is the expense. That means individual all expenses just 7,740, and all individual revenues account 10,600. Okay, so after balancing we will get this figure, that means 2,860. That means we will get this figure 2,860. Okay, so now drawing. According to question we have drawing 500. So the drawing close owner's drawing to owner's capital. That means in owner's capital this drawing will be closed. And closed revenue, here close revenues, this is the key point. Closed revenue to the income summary, that means this will 10,600 will be closed here. That means in our income summary. And number second, close expenses to income summary. All expenses will be closed here. That means in our income summary. So now we couldn't use further this name expense or revenue, but we will use only the differences. That means we call the differences is net profit or net loss. Here we are getting net profit. I think clear to everybody. So now owner's capital. So owner's capital, close income summary to owner's capital. That means now the income summary will be closed in our owner's capital. So income summary now vanish, now zero, and owner's drawing will be zero. That means this is vanish. So close drawing to owner's capital, this 500. So actually we know owner's capital actually 10,000, and this is the net profit 2,860, and owner's capital 500. So after balancing this figure we will get this figure, that means 12,360. We will get 12,360. That means 12,360. 360. This is now the owner's capital balance. Owner's capital is a permanent account. All other accounts are temporary accounts. That means expense temporary, revenue temporary, drawing temporary, and just all accounts closed to owner's capital accounts. So here owner's drawing is closed directly to owner's capital. That means this is the owner's drawing directly closed to owner's capital and not to income summary. Here this will not close to income summary. This will close to owners capital. Okay, so here key point: close revenues to income summary, close expenses to income summary, close income summary to owners capital, and close owners drawing to owners capital. That means again we can repeat: revenues, close revenues to income summary, close expense to income summary, okay, or close income summary to owners capital, and finally close owners drawing to owners capital accounts. We would proceed. This is the income statement of Pioneer Advertising, and this is the owners equity statement of Pioneer Advertising. For helping or preparing closing entries, just we have used these two statements, that means income statements and owners equity statements. So close, already we have shown how to close, but now this is the closing entries, that means preparing closing entries. Closing entries illustrated this entry, that means closing entry. General journal, this is the date column, account titles and explanations column, reference column, debit and credit. So service revenue, actually we know when we close the accounts, the revenue always debit, credit, sorry, revenue always credit, but here when we close revenue, service revenue or all types of revenue will be debit and income summary will be credit. So to close revenue account now close by this closing entries. Now October 31st, this is the closing date, that means the last date the year, that means here year 2017, but previous example I have shown 2020. 20 and 70 doesn't matter, but actually this is the last date of accounting period. Okay. Income summary, here expenses normally debit, but when you close the accounts, that times it will be credit. So all expenses 1 2 3 4 5 6, these 6 types of expenses will be credit and income summary will be debit. Now to income summary, one income summary is credit, one income summary is debit, but after balancing we are getting income summary debit and owners capital, that means the income summary will close to owners capital account. Previously I have shown this close income summary to owners capital. So this is the point: close income summary to owners capital, and finally owners capital debit and drawing credit. We know drawing always debit, that means drawing always debit, but here the points: owners drawing will be credit. When you close the accounts, the owners drawing will be credit and owners capital debit. So here please look here, this is the owners capital. Here owners capital 2860, this is credit, and here we close drawing close to owners capital, this is debit, that means owners capital debit. Okay, closing entry is analyzed, that means analyzed, finished. Now we can proceed to next slide. This is the posting closing entries, that means posting closing entries, that means here we have a lot of entries, just this is the ledger or posting closing entries. The supplies accounts, supplies expense, here the supplies expense 1500, this is the supplies expense. Depreciation expense, here the depreciation expense, this is the depreciation expense 40, the depreciation expense. Insurance expense 50, insurance expense 50. Then salaries and wages expense 5200, salaries and wages expense 5200, 4000 and 1200. Now rent expense, rent expense 900, rent expense 900, and then interest expense 50, this is the interest expense 50. Okay, so all the 6 expenses, all these 6 expenses are transferred to income summary. That means all expenses close to income summary. Okay, and now revenue accounts, we have revenues 10,600. This is the 10,600 total. So 10,600, and we have got this figure, a revenue 10,600. From here we have got it 10,600. So this is the 10,600 service revenue, and income summary is closed to owner's capital, and owner's drawing is close to owner's capital. Okay, so close revenue to income summary, close revenue to income summary, close expense to income summary, close all expense to income summary. Okay, please look here. This is the arrow sign, and 1, 2, 3, 4, 5, 6. This is expense close to income summary, and the revenues actually 10,600. Our revenue is close to income summary. Now this close income summary to owner's capital. This one, this is the balancing figure. This is our revenue. This is expenses. So this is the income, and close owner's drawing to owner's capital. This owner's drawing to owner's capital. So after balancing, we are getting 12,360. Now very easy to understand. Just close our revenue, expenses, and drawing. After closing, just other balances just we put in our post closing trial balance. That means this is the post closing trial balance. Here you will look no revenue, no expenses or drawing. So these items already closed. So after closing, we have 3 types of items: asset item, liability items, and owner's equity items, or owner's capital items. Okay, as these 3 types of items is permanent. These 3 types of items are permanent items. Okay, so here actually this is expense, depreciation expense, interest expense, insurance expense, rent expense, supplies expense, salaries and wages expense, revenues, and drawing. 1, 2, 3, 4, 5, 6, 7, 8. These 8 types of expense already closed. That means from drawing to expense, these 8 items, are already closed. This is closed. CLOSED, closed. End of the accounting period. And 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. These 12 items. This is the permanent items. It must not be closed. So this is the 12 items. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. These 12 items. Actually, these 12 items. That means this is the asset items, and this is the liabilities items, and this one, that means this is the owner's capital item. This is the owner's capital item, this is the liability item, this is the asset items. These items must not be closed. So this is the character of post closing trial balance. After closing these 3 items, revenue, expenses, and drawing, the rest items we will show in post closing trial balance. We call this is the post closing trial balance. Okay, I think everybody is clear. Okay, now I make you clear this do it to closing entries. The worksheet for Hancock Company shows the following in the financial statement columns. This is the owner's drawing, owner's capital, net income. Also prepare the closing entries at December 31st that affect owner's capital. That means this is the net income. How could we get it? Revenue minus expense equal to net income. So net income, how could we write down this? Net income summary debit or owner's capital credit. Owner's capital credit. Okay. Now drawing. Here we will get another journal, owner's drawing, owner's capital, owner's drawing. That means owner's drawing in normal sense we know this is the debit item. owners drawing. This is the debit item, but here just it will be credit. Owners drawing credit and owners capital will be debit. So actually owners capital, actually our total owners capital 42,000. This is our owners capital 42,000 plus owners capital 18,000. Owners capital 18,000. Okay, so 42 and 18 it will be 60,000. And finally owners drawing, this is the capital debit 15,000. So 15,000. After subtracting, we are getting 44,000. It will be closing capital now. I think everybody is clear here. Actually, this is owners capital 42,000. This is the owners capital. That means this is the net income 18,000. After addition, we are getting 60,000, and after subtracting owners drawing, we are getting 44,000. This is our closing capital. Okay. This all at this moment. I think in our next lecture you will join with us, explain the steps in accounting cycle and how to prepare correcting entries. We'll discuss on this topic. And this is the topic, summary of accounting cycle, reversing entries and correcting entries. We'll discuss on 3 subtopics. Thank you so much for joining with me.